Economics topic is split into two parts. One is microeconomics and the other is macroeconomics. In CFA, the bigger focus of our syllabus at level 1, also at level 2 and 3, is on macroeconomics. Because the world of finance is not really as interested in the behavior of individual consumer or producer. Mostly we are interested in studying the market as a larger, much more broader concept. So only at CFA level 1, you have microeconomics. And within this, we have just one chapter, firm and market structures. Macroeconomics has a much bigger discussion. We have monetary policy, fiscal policy, business cycles, geopolitics. Then we have trade, international trade and capital flows. And we also have discussion of forex. So macroeconomics is clearly the bigger side of economics discussion, with each of the topics by themselves being a small discussion, but overall in macroeconomic side of things. Now, in this entire topic, you have maybe one or two small calculations from the firm and market structures, mainly the HHI calculation. And here also you have a couple of small formulas in the form of money multiplier or fiscal multiplier. The crux of all numericals is forex. This is the only topic in our entire syllabus which has a few numericals that may be tested within the study of economics. So let's start with our discussion, beginning with microeconomics. The microeconomics study requires a basic understanding of demand and supply. So this is a topic that we generally cover as a prerequisite. Demand is willingness of consumer to consume product, and supply is willingness of producer to produce the product at given market prices. Now, there can be a lot of factors other than price also, which can affect the quantity demanded or quantity supplied. From those factors, we study the concept of elasticity, whether it is income elasticity or cross price. So all of that discussion is prerequisite. So we are not going to worry about that discussion. Our focus is the chapter of firm and market structures. Four types of market structures exist on the basis of certain features. First is perfect competition. Then we have monopolistic market. Then we have oligopoly, followed by monopoly. Now, all forms of market can be segregated from one another based on certain key features. The first of those key features is the number of firms. How many firms are we expecting to be operating in the market? So perfect competition, you can say almost infinite number of firms. Monopolistic will be high. Oligopoly is few firms, and monopoly is just one single firm. Then we have the concept of product differentiation, how different the product is between different firms which are operating in the market. So perfect competition assumes that we have homogeneous products. Homogeneous means all firms produce exactly the same product, identical in all aspects, not even close copy, 100% identical. Monopolistic has minor differentiation. Oligopoly will start having more major price differentiation. And we can't make a comment for monopoly because for us to decide whether product is differentiated or not, there has to be some product against which I can actually make the comparison. Then, after product differentiation, we focus on pricing power. How much power a single firm has to decide the price of their own products in the market. Pricing power is directly related to the idea of product differentiation. The more differentiated, the more unique my product is, the more I will have the power to set its price. So, pricing power in perfect competition, the firms are price takers. Price taker means whatever price is existing in the market, the firm will simply accept that and continue selling its product at that same price. So zero power to decide the price will be there with the firm. Monopolistic has some pricing power. Oligopoly has high pricing power. Monopoly has absolute pricing power, known as price maker. The firm has 100% control in deciding what the price of products is going to be. The last feature that we have is ease of entry and exit. How quickly a new firm can enter the market and how easily an existing firm can exit from the market. So in case of perfect competition, the entry and exit is completely unrestricted. Monopolistic has some restrictions. Oligopoly has heavy restrictions. And once again, this is one of those factors which we can't really define for monopoly because the moment that single firms exit, the industry ceases to exist. And the moment a second firm enters the market, it stops being a monopoly. So monopoly cannot really be judged on the basis of product differentiation or ease of entry and exit of newer firms. This is testable in the exam directly, where institute gives you some features of the market and then they ask you which kind of market structure are we talking about. So make sure you have clarity on these features. Now, in this entire chapter, apart from this discussion, the rest of your discussion focuses on how a firm will operate in either of these four market structures. So how will a firm decide what is the optimal level of production at which they should operate if they belong to perfect competition market, monopolistic, oligopoly, or monopoly? So one by one, let's take up that discussion. Starting first with perfect competition. In case of perfect competition, we start the concept by first defining cost curves. So we have marginal cost curve, which is basically cost of producing one extra unit. This curve takes its shape due to law of diminishing marginal productivity. Law of diminishing productivity says that productivity initially increases and then falls. So if productivity is how much work you're doing per unit of time or per unit of, let's say, raw material being used or any other resource that you're using in your business. So as your production increases for every unit of time, the cost per unit will fall. And as the resource becomes unproductive, the cost will start to increase. So if this is marginal productivity, the byproduct of marginal productivity is the exact inverse graph known as marginal cost. From this, we can draw average variable cost and we can draw average total cost. The point of intersection for average variable cost, average total cost, represents their lowest point respectively. And all of them are sort of like U-shaped curves, where so long as marginal cost is less than average, the averages are falling. And once the marginal cost exceeds the average, then averages start to increase. Now, this graph is universal for all markets. So even though syllabus teaches you these graphs for the first time in perfect competition, but you have to remember this concept of cost is not specific to a type of market. This is a concept based on factors of production. Marginal productivity talks about factors of production. And factors of production are needed for business in all types of market. So cost curves are going to be identical in all forms of market. The only thing that changes when we go from one market structure to another is the shape of revenue curve. So now for perfect competition, the revenue will be a horizontal line. And average revenue is always same as demand curve. Why will it be a horizontal line? Because this is a market where the firm is price taker. So whatever price is prevailing in the market, the firm will simply accept it and start selling goods at this price itself. And here we then add marginal cost curve. The point of intersection of the two tells us optimal level of production, optimal quantity. As per economics, this is the quantity at which the firm should operate to maximize their benefits. So here we have quantity and here we have cost or revenue. Now, in these graphs in your books, they have also included the aspect of showing economic profit or loss. So average total cost compared with average revenue. This gap tells me whether the business is going to be profitable or loss making at optimal level of production. So optimal quantity is decided as the intersection of MR and MC. So this is the point where MR is equal to MC, because marginal cost will keep going up. So this logic says you should only produce so long as the selling price of your next unit is more than its cost of production, because the cost will constantly rise. So idea is the moment cost exceeds your revenue, at that point you should stop further production. So once we have optimal quantity, at that quantity, if we compare average revenue and average total cost, this is referred to as economic profits. So intersection of MR and MC gives me the optimal quantity of production. And at this optimal quantity, the difference of AR and ATC, that tells me the economic profits. If let's say the graph were slightly different, let's say ATC was above AR, then this graph would be called economic loss, because now per unit cost is more than per unit revenue. So this is the concept that we have for perfect competition. Now, beyond this, books also cover discussion of two small topics. One is break even or shutdown point. So concept of shutdown is simple. If my revenue is less than average total cost, but it is more than average variable cost. So average revenue is somewhere in between. So in short term, we should continue the business, and in long term, we should shut down the business. And in case my revenue is not even enough to cover the cost of production, variable cost, then we recommend shutdown of business in all cases. So shutdown is basically where you are not able to recover your variable cost in short period of time. And if you are not able to recover your total cost over a long period of time, both of those require business to be shut down. And lastly, we have a discussion, economies of scale. Economies of scale is a graph which is formed by connecting a lot of different ATC curves. Each ATC curve represents one factor of production. So what happens in real world is businesses, when they start expanding, they also start using more and more resources. So if let's say this is labor in my factory, so initially I have just one worker, then as the workload increases, I hire a second, third, fourth, so on. So if I join the lower points of all of these, don't go by the accuracy of graph, the lowest points of all of these ATC graphs, if I were to join, that graph is called long run ATC. So this is the ATC of firm. And these are short run ATC, each of them. These are ATC of factor of production. The point where overall firm's cost per unit is going down, this is called economies of scale, because we are scaling up our business, more and more people are joining, and they are all operating at their efficient point. So it is economies of scale. Eventually, the business becomes too big to be managed as a singular organization. And at that point, we prefer to manage the business a little bit better. So this is diseconomies of scale. This is where if we don't make changes in the corporate structure, chances are my cost will keep increasing because of operational inefficiencies. Any doubts or queries? This wraps up the entire discussion we have for perfect competition.
Sir, what kind of questions usually ask in this kind of a chapter?
Theory questions. Plus, by this time, you guys should have practiced enough questions to know what kind of language institute will use. Then we move to the second form of market, monopolistic market. Monopolistic market has just one change in comparison to perfect competition. The change is now the products are differentiated, so firms have a little bit more power to decide their own prices. So cost curves remain exactly same, but MR and AR curve, they now separate from one another and they are now downward sloping. If I have control over the price of product that I'm selling, then chances are for higher quantities, I will be willing to offer more discounts. So this is a market where I can control my price. So price will have a downward sloping trajectory. And along with this, we look for the same concept, MR and MC intersection. This is labeled as optimal quantity. And at this quantity, the gap of AR and ATC. So AR, ATC are not to be checked randomly in this graph. They are to be checked at the exact point of your optimal quantity. So at optimal quantity, we will check the gap of revenue and cost. And whatever this gap emerges out to be, this is economic profit. So concept of perfect competition applies to monopolistic as it is. The only change you have to be aware of is that my revenue curves will not have the same shape as they did in case of perfect competition. And apart from this, one more thing that Institute may test out in form of theory questions is you have to understand in monopolistic because entry and exit of new firms is possible. So economic profits cannot be earned consistently over long period of time. Because if the business has economic profits, it will attract a lot of new firms to join the business. The market will be filled with a lot of new firms coming in, taking some market share away. So as more and more firms start joining the market, the competition becomes more intense. What will happen is whatever profits few firms were earning, now this has to be shared by a large number of firms. So slowly this profit will diminish. So idea is in monopolistic, no firm will actually be able to earn economic profits consistently over a very long period of time. Eventually, if the business is very profitable, it will attract a lot of new firms to form and enter the market. And that increased competition will take away the economic profits. All right. Moving on, the third form of market we have is oligopoly. Oligopoly market has four different models that we cover. Starting first with a kink demand curve model. The only thing that changes is now MR has a kink and AR also will have a kink. Apart from this, rest of the concept same. Wherever MR and MC curve intersect, that is optimal quantity. And at that optimal quantity, the gap of ATC and AR curve gives me profits. What is the logic for this kinked demand curve? Why are we observing this sudden change of slope? Oligopoly is a market with few firms. So this is one area where brand loyalty or customer affiliation, all of this starts to come into existence. So what happens due to all of these features is that customer is sensitive to price changes at different price levels. So if you are, let's say, using products of a particular company and the product is priced at, let's say, 200 rupees, a 10% increase in price may not really affect you too much. You're not going to switch over to some other product just because the prices have gone up 10%. But on the other hand, if let's say you consume a product which costs like 4 or 5 lakh rupees and that sees a 10% price increase, now you will start looking for alternatives. So this concept says that consumers are not sensitive to price changes equally across all prices. At high prices, there is a different slope. And at low price levels, there is a different slope to how consumers will react to price fluctuation. So this is one model of studying oligopoly. Then we have Cournot duopoly model. Cournot duopoly model says that smaller firm will use aggressive marketing to gain market share. And this will keep going back and forth between the firms until both firms eventually settle for roughly similar sort of market share. Real world is filled with examples of Cournot model. In India, we have Jio, Airtel, we have Uber and Ola, we have Amazon and Flipkart, all of whom were very aggressive when one firm was smaller and the other was larger because the smaller firm will want to gain more market share. Until eventually both of them reach roughly similar market share, they are happy with their market presence. And that point, the competition starts to diminish away. Then we have Stackelberg dominant firm model. Stackelberg dominant firm says that market has one dominant firm and other smaller firms. Smaller firms will not have as much pricing power in the market. The dominant firm will basically enjoy most of the power of this kind of market. where smaller firms will primarily be reacting to the decisions taken by the larger firm. And lastly, we have Nash equilibrium. This is a model of duopoly. And for Nash equilibrium, this has two possibilities. If this is applicable in a market with competition, then you decide for each party separately. So if two firms are operating in the market and they both have some business choices, A doesn't know what B will do, B doesn't know what A will do, because they are competing with each other. So in this case, both will take decision independently, separately, without knowing what the other party may decide. And the intersection of both of their decisions in the market, that will create the market equilibrium. The other possibility is we may have collusion. Collusion means where firms are working together. In this case, we decide as per highest combined benefit. So whatever this set of decisions creates the maximum combined benefit for both the firms, that is referred to as my equilibrium. And mostly in collusion, what will happen is once that maximum benefit is identified, both the firms would often end with 50-50% of that maximum benefit. So it's not necessarily that both firms will receive equal amount from the market, but if one firm is receiving more, the other is receiving less. But overall, in a combined manner, this is the best that they can achieve financially. So then they will agree to share the profits. So there will be some revenue sharing in case the earnings of both the firms are not quite equal in this scenario. So these are 4 different models of studying oligopoly. All right. Last structure that we have for microeconomics is monopoly. In case of monopoly, graphs and everything in your books are same as monopolistic, because monopoly can take any form of graph shape, because firm is the price setting party. So any graph will work for studying monopoly. Monopoly can come due to 2 reasons. One is called a natural monopoly, where maybe the industry was monopolistic, then it transitioned to oligopoly, and slowly within oligopoly also one large firm emerged and all other firms slowly started exiting the market, or maybe the large firm acquired some of them and started eliminating a few from the industry. So if a monopoly is formed naturally out of business, out of competition, that is referred to as a natural monopoly. Sometimes monopoly is formed on the basis of legal restrictions. So sometimes rules and regulations, they may be the reason why certain companies are not allowed to enter in some markets. So that is referred to as a legal monopoly. Mostly when we look around us, we find examples of legal monopolies. For example, railways or defense. These are restricted from the government, that a lot of private firms or a lot of competing firms cannot enter this market space. So most of the times in real world, what we see is a legal monopoly created due to regulations. Now, for monopoly, we generally combine it with the discussion of trade restrictions and deadweight loss. In your syllabus, both of these are discussed in trade chapter, but it makes more sense and for easier understanding if we combine this discussion with our topic of monopoly. So essentially, we start with the idea that demand and supply, it creates an equilibrium price. And what happens due to this equilibrium is that both producers and consumers, they have some benefit from it. So I have some benefit for producers and some benefit for consumers. Whatever benefit is there for the consumers is called consumer surplus. And because of free interaction of demand and supply, there will also be some benefit for producers. This is called producer surplus. This is how normal market operates, where demand and supply are interacting with each other freely without any sort of restrictions. This is normal market. When we transition to monopoly, what happens is, because the firm now has absolute control over deciding the prices, so what they end up doing is they end up exploiting the consumers. And in that process of exploitation, all of the surplus becomes producer surplus. Now, sum of producer and consumer surplus is called economic surplus. So we define equilibrium as the point where economy is at its maximum surplus. So does monopoly affect economic output or economic benefit? Answer is no. The problem with monopoly is that all of the benefit that consumers get due to competition in market, due to free demand and supply in the market, all of that benefit also transfers over to the supplier. So problem of monopoly is that monopoly will not share the surplus between consumer and surplus. Monopoly will end up taking all the surplus, all the benefit of the economy just for that one single firm. To prevent this, or to prevent the consumer exploitation that is happening as a result of this, often what happens is trade restrictions will be imposed. So maybe a price ceiling is put in place. Maybe a quantity limit is put in place. So these are referred to as trade restrictions. Because even though economy is not really suffering due to monopoly, consumers are not happy. And when consumers are not okay, we will need regulators to step in and fix that problem. So when regulators step in, let's say they say a certain maximum price of 100 is allowed. So all the transactions above the price 100, they are essentially no longer allowed in the economy. So this doesn't become consumer surplus. This is surplus completely lost from the economy. Why? Because if, let's say, a government says that you can't buy a product at a price more than 200, now as a consumer, your willingness about 200 is not relevant, because now what you're willing for is irrelevant. It is illegal. If you as a consumer were willing to pay 500, but government has put a legal limit of maximum price, now if you pay 500, you are violating the law. So logic says that when trade restrictions are imposed, this section doesn't create benefit back for consumers. This is essentially taking away the benefit permanently for the economy as a whole. So this surplus is lost permanently, and we call it deadweight loss. So monopoly is only limited to this concept that they will take away all the consumer surplus and convert it into producer surplus. But then from that emerges the idea of trade restrictions, and from trade restrictions emerges the idea of deadweight loss. Any doubts with this? Let me know. Apart from this, for your exam, HHI and concentration ratio. These two formulas you should remember. Very likely that you may get one basic question from this. If you remember the formula, the question is easily solvable. So HHI is sum of square of market share of n number of largest firms, and concentration ratio is simply sum of market share of n number of largest firms. Concentration ratio is useful to study how the market is right now, and HHI is useful to study how the market will change in response to some merger, acquisition, or corporate restructuring. All right. So this is our entire discussion for microeconomics. Now, the second part of economics syllabus for CFA is macroeconomics. And the good thing is macroeconomics is a lot of chapters, but all of them are relatively smaller discussion. So we'll start with it one by one. First, business cycles. We'll take up the entire note in the form of a mind map to summarize the entire chapter in one single slide. Business cycle refers to the fluctuations that we see in the economy. So mostly it follows this particular pattern. In general, trajectory is always going upwards, but we see cycles. So over here, we classify the phases. So this entire phase, this is referred to as phase 1, expansion. Then we reach phase 2, which is peak, where the expansion is starting to slow down. This is followed by the third phase, which is recession. Recession is slowdown of economy, sometimes even negative growth. Now, as we had discussed in our main lectures also, in real world, it's not necessary that every business cycle will have this shape. Not every economy will face recession when GDP is falling. On y-axis, here we have GDP. So it's not necessary that this graph has to actually fall for us to call it a recession. For a country which is used to growing at 8, 9, 10% per annum, even a fall to 2 or 3% of growth will be as good as recession. So in real world, recession is not defined as fall of GDP. It is simply a very rapid slowdown in terms of normal GDP growth rate that we are used to experiencing. And finally, this is followed up with the fourth phase, which is referred to as trough. Trough is exact opposite of peak. Peak is slowdown of expansion. Trough is slowdown of recession. Trough is also sometimes defined as initial recovery, because this is where the effect of recession is starting to slowly lift up from the economy and we are starting to recover a bit. So essentially this initial recovery sets us or the economy for the rapid expansion, which will be the next cycle beginning. So 4 phases of the cycle. Now, for us in this chapter, we should be able to define the phases based on some indicators. So where exactly an economy is at any given moment of time, that is decided based on certain indicators. So we have 3 types of indicators: leading, which are used for predictive analysis. They tell me some change is about to take place in the economy before the actual change takes place. Then we have coincidental, and lastly, lagging indicators. Coincidental show a change while change is ongoing in the economy. So they essentially give us an update of the current situation of the economy. And lagging are primarily used to confirm that a change has actually taken place in the economy. So if we look at all economic calculations, GDP, inflation, unemployment, all of them are lagging because we calculate GDP for a country after the completion of year. So if let's say financial year is from 1st April to 31st March, and then we calculate GDP, we get the final numbers sometime in the month of May or June. So we are calculating in the month of May or June, but the data belongs to the entire previous financial year. So lagging ones are mainly to confirm what actually happened in the economy in the past. From these indicators emerge some theories. Theories try to explain why the business cycle actually exists. Why do we see this cyclical movement of up and down movement constantly? Why can economy just grow at a constant rate? So we have different theories. First is neoclassical, which gives the reason as technology. Technological advancements which generally affect public at large, which affect the masses, they are responsible for changes. That is what neoclassical theory concludes. Then we have Keynesian theory, which puts the blame on labor. Specifically, it introduces the concept of downward sticky, meaning that labor, you can increase the wages very easily when the economy is doing good. But when the economy starts to struggle, at that point, reducing the wages of labor becomes very tough. So if labor is not accepting low wages as easily as they are accepting high wages, now the business owners are forced to do layoffs to cover the cost. And when layoffs happen, it triggers unemployment. Unemployment reduces the income that people are spending. So demand goes down. When demand goes down, it affects the supply side of things. Then came the new Keynesian theory, which applied this concept of downward sticky to all factors of production. So all factors of production exhibit this feature. That is the conclusion of new Keynesian theory. Then we have Austrian theory, which blames the government policies. Governments keep changing their policies, regulatory framework. So that is often explained as the reason for cycles. Then we have monetarist theory, which claims that monetary authority, in our case in India, we have RBI. So they constantly keep changing the interest rates. And that becomes the reason for all the fluctuation that we observe. And then finally, we have new classical theory, also known as real business cycle theory. So both names are used. This says that there are many variables. A single variable is not enough to cause a change in the economy. The economic cycles are a result of many things happening in the economy at the same time. So maybe forex, inflation, unemployment, all of these going bad at one moment of time, that can trigger recession. Generally, economies are very large in the modern day, where one single factor going bad is not going to be enough to trigger the recession. Then, apart from this, the chapter has a small discussion about unemployment. Where we have discussion about the meaning of unemployment. Anyone who is willing and able but not finding work is considered as unemployed. And apart from this, we have three types of unemployment. Frictional, which is the time gap between jobs. So when you're changing from one job to another, the time gap in between is frictional unemployment. Then we have structural, which is due to permanent shift in the economy. So AI related job loss, or in automobile industry, companies are switching from petrol and diesel to electric. So they will no longer require a lot of engineers who are specializing in these diesel or petrol engines. And then we have cyclical unemployment, which essentially takes place because of business cycles. So in recession, the jobs will be lost. And in the next expansion phase, the same jobs will be recreated once the economy starts to recover. So this is your entire discussion for the topic of business cycles. The next chapter we have in macroeconomics is monetary policy. Monetary policy is the policy of controlling money supply. So first thing is the word money itself. You should have good clarity on what we mean by money. It should have three features. It is medium of exchange, unit of account, and store of value. Now, this money, its supply can be studied in the form of a vertical line on this graph. Why? Because here, if we have quantity and we have, let's say, rates, demand of money is inversely related to the rates. Because if the rates are high, people will prefer to invest their money, so they will have less requirement for money to spend. Demand of money mainly comes from you having the need to do any transactions. So as the rates increase, the need for money to do transactions reduces as most of the people are interested in saving and investing. So demand is based on interest rates, but then we have supply as a vertical line because this is controlled by monetary authority, central bank, as we call them. So from time to time, central bank will increase or decrease the supply, and it will start creating an impact on the rates and the demand for the money. So it will keep shifting the equilibrium. Now, question comes that when central bank is deciding the supply, what all factors will they consider? How do we come to a conclusion as to how much money we actually need in circulation in the economy? So when deciding how much supply is actually needed to support the economic activity, two factors are considered. One is money multiplier, which is simply 1 upon reserve rates. This is the multiplier effect that banking system creates. So if I introduce $1,000 in the bank will only keep some of it with itself and rest it will give out as loan. Now, whatever is given out as loan will eventually circle back into the banking system. Again, some second bank will keep some reserve and give the rest of it out as loan. So introducing $1,000 in banking system doesn't create an economic impact of 1,000. It's a much higher effect. So if banks are required to maintain reserve, let's say 20%, 0.2, then multiplier effect will be 5 times, which means every $1 introduced in banking system creates an economic effect of $5. So this will decide how much supply we need because supply would often be the money in circulation. But if I have a GDP of, let's say, $4 trillion, it doesn't mean that I need that much money in circulation because money is used repeatedly. You can do a transaction with a 100 rupee note. That 100 rupee note, let's say I receive, then I pay it to someone else to do a transaction. So that second effect is what we call money velocity. How many times a single unit of currency is being reused to do multiple transactions. So how much multiplication effect banking sector will create and how much repetitive use of a currency unit we get in the economy. Both of these things will give central bank an idea as to how much money they actually need in circulation. If the multiplier and velocity are very high, then I don't need to print too much currency. And if the multiplier and velocity are very low, then to support the economy, I will have to print a lot of currency. From this, we finally reach the discussion tools of monetary policy. How does central bank actually change the money supply? So three tools are used. One is policy rates, which in India we refer to as repo rate. So this becomes the rate as per which all the banking rates are decided. So this becomes a baseline. If these rates go up, generally all interest rate securities will have increment in rates. Then we have reserve requirements. Directly tying with money multiplier. If reserve is high, the multiplier will be low and vice versa. And third thing that central bank does to control the supply of money is open market operations. Open market operations simply means that central bank will itself participate in the market as investors. So when they feel public has a lot of money, they will issue government bonds. So when public buys the government bonds, RBI will receive the money and public will have less of it to spend. Similarly, if RBI or central bank feels that the government has too much money and we need to now circulate it amongst the public. So at that point, they will buy back the bonds. So essentially, when they buy back the bonds, the money will go back to public. Public can now start spending it. So money supply or how much of it is in the hands of consumers, that can be controlled by open market operations. Now, these tools can be done with several objectives in mind. Three main objectives exist, and at any point of time for a country, all three will be valid. But generally, depending upon the nature of economy, one may be a more relevant factor as compared to the others. So if we look at objectives, we can have inflation targeting objective, where the objective of central bank is to control how much inflation we actually have in the economy. We don't want economy to be exposed to too high inflation, because sometimes there are economies which are very heavily affected by high inflation rates. Then we have some economies which focus on interest rate targeting. Very common in case of Indian economy, where our objective is we want to keep interest rates at a very good balance, where they are high enough to attract people to invest the money, but they are also low enough for people or businesses who are interested in borrowing funds. So loan should be available at relatively accessible rates, and investors also should be getting decent returns. And then third is countries which are very heavily exposed to forex rates. So they generally have policies designed to keep forex rates as stable as possible. Forex rate targeting strategy. Now, all of this finally leaves us with one limitation of monetary policy, one big drawback that we have of monetary policy. The drawback is that monetary policy tends to fail during times of crisis. Understand. If economy is in crisis, we are in recession, not looking at a recession, but we are actually in the recession right now. In such an economy, unemployment will be high. People are not very sure about their income levels. So in such a case, do to push the economy back to recovery, they can reduce the rates. But the practical issue is that if I, as a consumer or as a citizen of a country, if I am not sure about my job or future income, no matter how low the rates are, I will not go on and take loan. In a risky environment, taking loan may not be something that people will be willing to do. And since monetary authority can mainly influence this entire scenario using mainly the policy rates or the interest rates which exist in the market, the problem is interest rates are not a relevant way to fix a crisis once you are already in the crisis. For that reason, monetary authorities all around the world, they are very proactive. They don't wait for the recession to actually take place. If they feel that, yes, in the next 1 or 2 years, recessionary pressure will build in the economy, the inflation is too high, forex rate is going bad, unemployment is there, they will take actions before the crisis actually emerges. So monetary authorities, they have a limitation that all the tools at their disposal, all of this will fail once you are already in the recession. So for this reason, all authorities, they prefer to act proactively, take decisions before the crisis actually happens, so that whether you are able to stop the crisis or not, that's a separate matter. But if I can prepare the economy for the crisis, then chances are I can also structure and plan when the recovery will be suitable. So most monetary authorities, they don't change interest rates when the economy is in the recession. They will make the changes just before recession and just as the threat of recession is finally starting to fade away. So these policies, they only work when they are implemented in a proactive manner. Proactive means ahead of schedule. So you have two words, proactive and reactive. Reactive means we let something happen and then we react to it. Proactive means I am not waiting for something to happen. I am planning for it in advance. So monetary authority or monetary policy works when it is proactive in nature. All right. Next up, we have discussion of fiscal policy. Fiscal policy is the policy of government revenue, which will come in the form of taxes, administration fees, and so on, versus government expenditure. Now, in this entire concept, apart from knowing the sources of revenue and expense, there are just two broad discussions in this entire chapter. One is fiscal multiplier. Just like banking system has a multiplier effect, similarly, the taxation system also has a multiplier effect. Why? See, if let's say I earned 1,000 rupees, from this I paid tax 30%. The remaining 700 is what we call disposable income. Disposable income is income minus taxes. It is called disposable because I have choice how I will use this income. So when you have that choice of how you are going to use this money, it is up to me how much of it I want to spend and how much I want to save. So let's say I decide to spend 500 and I save 200. The percentage of disposable income that I save is called marginal propensity to save. And the percentage of disposable income that I decide to spend, that is called marginal propensity to consume. So sum of marginal propensity to consume and propensity to save will be 100%. So idea is, in the income tax system, whatever money I spend, this will become income for someone else. So I paid taxes on my income, then I make the spending. This spending becomes income for someone else. When that someone else earns the income, they will now pay taxes on it again. So it creates a cycle, it creates a loop. This is referred to as fiscal multiplier. So in contrast to money multiplier, we just had reserve. Fiscal multiplier will have effect of taxation and propensity to consume. Because whatever money I decide to save and invest, it stays with me. It may earn returns, but those returns belong to me. So whatever I save and invest will create income for me in the future. But whatever I decide to spend becomes income of someone else today. So fiscal multiplier depends on two things. One is the tax rate, and the other is what percentage of income people in the country are generally spending on consumption. So marginal propensity to consume and tax rate. Both of these are relevant for fiscal multiplier effect. And then second aspect of this chapter is the limitation of fiscal policy. The biggest limitation of fiscal policy, easy to remember. What are the biggest limitations of all government policies? Lag. Lag basically means that it takes time for the policy to actually show its effect. Firstly, there is a lag to identify a problem. If economy is going through some distress, the government would often confirm it using unemployment, inflation, GDP data. So data is anyways lagging in the first case itself. If economy is going through recession in this financial year, data will only show this effect when we finally calculate it after a few months. So when the calculation happens, then a problem will be identified. So firstly, there's a lag in identifying the problem. Then there is a lag or time it requires to formulate an action plan. So once there is a problem, government schemes generally take a lot of discussion and so on. So a lot of bureaucracy is involved and a lot of time is wasted there. So that is action lag, where acting on a problem, creating a resolution plan, all of that requires time. Once we have a plan of action, then its implementation further creates a lag. So lag happens in all three phases. Lag of identification of a problem, then lag of taking action on the problem, and finally, lag of implementation of our action plan. So this is a limitation not for just fiscal policy, but whenever government creates policy, all of them are exposed to the same set of limitation. All right. Next up, we have geopolitics. Where the entire chapter focuses on four aspects of geopolitics. Firstly, we have the basic meaning. It is the interaction of state and non-state members. across national boundaries. So it's not just about how one government deals with other national government, but also one government's policies for other countries, companies, foreign investors. So geopolitics, we create a spectrum based on two factors. One is openness to trade. So we have globalization, countries which are open to trade, and we have nationalist countries which are closed, which don't prefer trading too much. And then we have countries which are non-cooperative, not very open to dialogue, and we have countries which are cooperative. Based on these factors, all countries around the world are classified into four categories as per their geopolitical stance. So here we have autarkies, which are not very active on trade and not cooperating on global matters. Then we have countries which are active on trade but not very cooperative. These are called hegemonies. Then we have countries which are cooperative on global matters, but they are a little more conservative when it comes to trade. They generally trade only on their terms and conditions. So these are referred to as bilateralist countries. And then we have multilateralist countries. This is where most of your real world economies will fall. So we have meaning, then we have classification of countries, and this is then followed up with two small discussions. First is risk of geopolitics. Where we have three types of risk. One is risk associated with events. Event risk means I know that some global event is going to happen, but I don't know the outcome. So maybe election in some countries. So we know when elections are going to happen, but we don't know the outcome. So here event is known, but the outcome is unknown. That is the uncertainty, that is the risk. Second possibility is exogenous risk. Exogenous means event is also unknown and outcome obviously is unknown. COVID outbreak or war situations that happen, they are referred to as exogenous risk. Reason is I don't know what event may happen which can create uncertainty for me. So over here, I at least know the event, I just don't know the outcome. So we can prepare for all possible outcomes. But in exogenous, we don't know when an event may take place that may require some global matters to be discussed. And finally, we have thematic risk. These are issues which require more long-term global cooperation, things like climate changes or global pollution issues which are happening, ozone depletion or global warming. These are matters which require cooperation of a lot of entities, and all of them need to cooperate for a very long period of time. So that is referred to as thematic risk. And lastly, tools of geopolitical policy. So geopolitics was defined as interaction of state and non-state members. So how exactly will this interaction take place? It takes place either in the form of economic tools, which will be trade restrictions sometimes, as we saw from US last entire couple of years, a lot of trade sanctions being imposed, a lot of tariffs being imposed. That is economic tool of geopolitical policy. Then we have financial tools, which basically put restrictions on investments, foreign investments. And lastly, we have national security. Some actions are taken to restrict other countries primarily due to reason of national security. For example, India, a couple of years ago, we banned a lot of apps because they were of Chinese origin, storing data in China. So government found that that is not acceptable for national security. So sometimes the interaction or the rules which we make, they are brought into effect over the security of the country. So national security is cited as the reason for those kind of interactions. Any doubts or queries?
Sir, in hegemonies, how the things will, which kind of company will come?
Company or country? This is
Sorry,
classification.
my bad. Countries. Which kind of means, because multilateral, I understand. But
Yes.
here, which two company will trying to do the globalization means in terms of they will try to do the business also and they are non-cooperative also.
US right now is a hegemony.
Okay.
They are interested in trade, but they are not cooperating very much with a lot of other entities. So all of these in main notes also and here also, I would not prefer that you rigidly assign countries because where a country falls can change based on time. So it is possible a country may be hegemony right now. After a couple of years, it may be a multilateralist country. So no rigid examples can be created. So these to be assessed on case by case basis.
Hello.
Yes, Kamal.
Right now, he's telling me he has requested for this data for this.
हाँ
Kamal,
तो यूटिलिटी का डेटा केवल बैटरी का बना था ना, मैं मांग रहे थे L1 के लिए।
Kamal, mic is on.
सर डेटा नहीं मिल रहा है, मांग रहा हूं मैं भी, उसने मेल डाली है उसी के लिए।
Students are not taking this revision seriously at all. This is not a matter of convenience. All right, moving on. Second last topic we have is international trade and capital flows. Now, this entire topic of international trade and capital flows, the chapter has 4 discussions. First is a very basic, some trade related terminologies. Just read through them once. There's no need to have them here in the mind map. But from trade emerges the idea of trade advantages. Trade advantages is not the same thing as advantages of trade. All right, English language knowledge, very important. Here, what we are trying to say is, why do some countries perform better in trade as compared to other countries? So we have 2 theories which explain this. One is an absolute advantage. A country has absolute advantage when they have lowest cost of production. So some countries, they generally have abundance of certain resources. So in those countries, producing certain goods becomes very low cost. So some countries have a natural advantage because of resources that most of the production work for certain goods will happen in those countries only. That is referred to as countries that have an absolute trade advantage. That essentially they are going to perform better than others because they have the lowest cost of production. Then we have another set of countries which are having relative advantage. Relative advantage is lowest opportunity cost of production. What do we mean by opportunity cost of production? Opportunity cost means that when we devote some resources to take up some production activity, some of those resources have to be taken away from some other business opportunities. So let's say a new company comes in and they decide to set up a factory in India. They are not going to hire all the people who are unemployed. Some of the people they will hire will be from people who are already engaged in some other jobs. Some new people may get job opportunities, but most of the times what happens is they will hire people with some experience. So people who are already working in some other business, they will now be asked to come and work for this new business setup. This essentially means that a country has underutilization of resources. So we don't have a problem of unemployment. First one means we just have a lot of resources. So there is a lot of unused capacity that we can benefit from. But the second one says we don't have unused capacity, we have underutilized resources. So let's say I have all the people in the economy employed, but they are not employed as per their skill. So what we see is this is one of those things where India can be a very good example, because for a long time we had a lot of population engaged in agricultural activities. But you may have studied in your school days that there is a form of unemployment known as disguised unemployment, where essentially number of people engaged may increase, but the output may not increase. So that is a case of India having a relative advantage, that we have that spare capacity of resources of people who can move from their existing work to new work, and that will benefit the economy. So over here, we are saying our resources are used currently in some business opportunities, which are not really using our resources to their maximum potential. So that is what we mean by countries having a relative advantage. Now, from this, in your books, they then start with the discussion of trade restrictions and deadweight loss, which I would also suggest for your study, combine it with monopoly rather than doing it here in this chapter, because monopoly makes it much more easier to understand trade restrictions, like why we need them in the first place. When you study trade restrictions here, one of the questions that always comes up is why do we need trade restrictions? So studying it when monopoly solves that entire area of curiosity. This is then followed up by discussion of trade unions. Trade unions is where different countries come together, they form a trade bloc or a trade community where they end up accepting some rules and regulations. So the most common form of trade union is free trade area, where we have benefits of movement of goods. Then on top of it, we add customs union. Customs union will have the feature of free trade area, plus we have common rule for non-members. So countries who are not part of the trading union, they will essentially have to deal with the same set of rules. For example, if let's say India and Nepal, we form a customs union. So now all the foreign countries, whether they are trading with India or with Nepal, they will face same set of rules. So whether a country, China, wants to export their goods to India or Nepal, they will face same rules. So that is a customs union where members have unrestricted movement of goods and services, and non-members are exposed to same set of rules and regulations. Then we get to common market. Common market is a situation where, apart from these two features, we allow movement of labor and capital. So even resources can move freely from one country to another. And then we have economic union, where we have common economic institutions. And finally, we have monetary union, where countries adopt a common currency. By nature, understand monetary union will be all four. So if I say European Union is a monetary union, it also means it's an economic union, common market, customs union, and free trade area. So if some union is monetary, it will be all four. So every monetary union is a common market, but every common market is not a monetary union. So do understand, that's why we suggest that you remember these names in this exact sequence. Now, apart from this, you have one small discussion which from your main class notes or books itself, there's no need to further write a. You have a discussion of balance of payments. So balance of payment is nothing but a detail of all the money flowing into a country and all the money flowing out of country. So we segregate all of these inflows and outflows into three categories: current account, which focuses on trade and one-sided transactions. One-sided transactions are where we don't anticipate any return obligation. So for example, parents sending money to child who is studying in foreign countries. So that is a one-sided transfer. Similarly, you get a job in foreign country, so you're sending money here to your family in India. That's a one-sided transfer. There's no return obligation. So we have current account, which focuses on trade and one-sided transfers. Then we have capital account, which focuses on long-term assets, and financial account, which focuses on financial securities in which we can invest. All right. Last topic of our discussion for today is Forex. Forex has two parts. One is calculations, and then we have some basic theory. Calculations of Forex are very easy, provided you remember some formulas for the exam and you understand some of the logic. Like instead of treating these calculations as standalone within this chapter, link the forward rate calculations with derivatives. So that will help you understand the forward calculations and forward premium and discount calculations easy. So calculations are easy as you start linking them with other discussions that we've had in our syllabus. So firstly, for calculations, there is basic terminology. The basic terminology of Forex is essentially understanding the quotations. So if I write rupee per dollar, rupee is my price currency and dollar is labeled as base currency. If price currency matches the domestic currency, we call it direct quotation. And if price currency and domestic currency are not matching, we call it indirect quotation. Direct and indirect is just a matter of convenience. What may be direct for an investor in India may be indirect for an investor outside of India. So this is relative to the investor. But idea is, if I say rupee per dollar is 90 and you want to convert it the other way around, so dollar per rupee will be written as 1/90. So it's just as simple as doing a reciprocal. From this, we get one of the more important concepts, which is cross rates. Cross rates are essentially a no arbitrage calculation. So just for example, because in exam, you will have to create these equations yourself based on the question. So just for sake of example here, if let's say you have to calculate dollar per pounds, so you can calculate it as dollar per rupee and rupee per pounds. So essentially, these two rates already exist in the market. As per them, what should be the implied exchange rate of dollar and pounds? This is ideal. It is possible that the actual dollar and pound rate I find in the market may be different than what I'm trying to suggest here. So this is very similar to the valuation topics that we study in equity or fixed income, where this is intrinsic value and what we find in the market, that is actual. Whenever intrinsic and actual are different, there may be some exploitation of arbitrage that we can do. So for that, even though arbitrage is not explicitly part of your syllabus, but in rare cases where you get a question from it, I will give you one simple rule. This is ideal. And actual exchange rate, the question will tell you in the question. So when you compare the ideal with the actual, if ideal is less than actual, then base currency is overvalued. Always make your conclusion on the base currency. So if this is dollar per pounds and I find that this number is less than the rate I'm finding in the actual market, so it will mean pounds in the actual market are overvalued. And once you know what is overvalued, you can then decide whatever is overvalued, we sell it, whatever is undervalued, we buy it. So this rule will help you in some theory questions that may be asked surrounding how arbitrage opportunities can be exploited. The reason why I say arbitrage calculations are not explicitly part of your syllabus is because in real world, we don't have this single quotation system. In real world, you have a bid rate and an ask rate. And as per that, we do the calculations. And all of those detailed calculations from cross rates are part of your CFA Level 2 syllabus. So for that reason, I generally suggest that it is not very likely for arbitrage to be tested here because this is a very unrealistic application of the concept. So in case you get questions, this rule should help you identify that whenever ideal is overvalued and whenever ideal is more, the base will be undervalued. So once you identify which currency is overvalued and undervalued, you can accordingly proceed with your calculations. Then we have forward rates. Forward rates are calculated as spot rate 1 plus rate of price currency upon 1 plus rate of base currency adjusted for time. Now, this is one calculation. Alternatively, you also have forward rate as spot rate plus minus forward points. So sometimes question can give you the forward points. Sometimes they can give you information of the interest rate which exists in both the countries. You should be comfortable calculating it from both approaches. Do understand forward points always adjust from 4th decimal onwards. One exception to this rule is the USD and Japanese yen exchange rate. So when you have questions where dollar and yen are involved, over there you take it from 2nd decimal onwards, but in all the other questions, you will take it from 4th decimal onwards. And from this, we get our final equation, which is calculation of forward premium or discount. This is just telling us an idea that forward is nothing but an expectation of spot rates after some period of time. So am I expecting the exchange rate to go up or down for a currency? Is a currency expected to get stronger or weaker? That is our focus here. So this is calculated as forward rate minus spot rate upon spot. But apply this formula only for base currency. So if let's say you have rupee per dollar quotation and you want to find out its forward premium, this formula will only give you whether the dollar is at a premium or discount because dollar is the base currency if I write the quotation like this. If I want to do calculation for rupee, I will first need rupee as base currency, then I will apply this formula. So the formula only works for base currency. Why is this important? If dollar is getting stronger by 5%, it doesn't mean rupee is getting weaker by 5% because that will also be one of the options. Institute knows it's easy to confuse students when they are in the flow of exam. So make sure you remember this. The formula will only work for base currency. So do not apply it to the price currency. If you want to calculate for, let's say, rupees in this quotation, you will first convert your quotations into indirect and then apply them in the formula. All right, last section of Forex discussion is the theory. So related to Forex, we have 3 sections of the theory discussion. First is just focusing on demand for Forex. What will create demand for Forex? The demand can come from transactional reasons. Where let's say I want to import or export something, or I am traveling abroad and I need the foreign currency. So I convert from one currency to another. So sometimes the demand will be due to facilitating transactions. Then we have a speculative demand. Speculative means purely for investment reasons. I want to buy dollars because I feel dollar will increase in value. And sometimes we may have precautionary demand, which is mainly going to come from some entities who want to cover their forex risk. So it could be central banks maintaining forex reserves. It could also be companies who are very actively engaged in import and export who want to cover up the risk that they may be exposed to due to fluctuations of forex rate. So both may fall here. Then, second aspect of this chapter is how countries manage their forex rates. Two types of countries exist, one that have their own currency and countries that have no own currency. Now, countries that don't have their own currency, they will simply adopt currency of someone else. And along with adopting currency, they will also adopt policies of that other country. Because logic says that whatever currency you are using, you should have the ability to print it so that you can control its supply. If I don't have my own currency to begin with, I will not only have to adopt currency, but also the monetary policy of the country whose currency I am trying to adopt as it is. If we have own currency, we have currency board systems where we put a blanket restriction on exchange rate. Currency board will decide the exchange rate, and whatever they decide, all the market, if they find it acceptable, they have to transact at that exchange rate. So if we go all the way back in India after independence, we had currency board which set the price at sometimes 1, then 10, then 20. So from time to time, they will meet and they will decide an exchange rate, and only at that rate, forex can be done. Anyone who doesn't find the rate acceptable, they are simply not going to be engaging in this market. Then we finally move to pegged arrangements. Here we still have currency board, but the idea is this time currency board will give one exchange rate, but along with the exchange rate, they will also give pegs. Pegs are basically acceptable movement. So let's say currency board says that rupee and dollar exchange rate is going to be 50 rupees per dollar. But then they decide that we'll peg it to 5%. So idea is from whatever rate is decided by the currency board, 5% above it, 5% below it, movement can happen based on demand supply. So anyone who wants to transact in the market, they are free to do so within the entire range of acceptable forex rates. And finally, we get to floating arrangements where we leave the entire forex to market forces of demand and supply. Mostly here also to control it. Some countries, they have forex reserves. Some have the ability to completely block forex trades, like Russia did when Russia-Ukraine war initially happened. Russia completely blocked the trades on ruble currency throughout all the regulated markets. So here, the forex rate is at the mercy of market forces of demand supply, but monetary authority may be able to do some actions or some policies to control how much fluctuation we are seeing in the forex. So it won't be complete control, but it will be an influence that we can exert as and when required. And finally, in this chapter, the last discussion we have is effect of forex on trade. So we have three theories here. First is J curve, which says that over a short period of time, firms do not react to forex rates. So if this is where forex rates change, for a short period of time, businesses will accept the losses. But if the change persists for a long period of time, slowly the businesses will adapt themselves and they will start to transfer off this burden to the customers. So on very short periods of time, businesses do not react to whatever changes are happening in the forex rate. It is only when those changes persist for a long period of time that businesses will take corrective actions. Then we have elasticities approach, which focuses on goods imported versus exported. The idea of this theory is that if we are importing essential items, then no matter what the forex rate is, we will still have to import them because essential items are the ones that you can't give up consumptions. So this theory says that how forex will affect your trade actually depends on what kind of goods you are importing or exporting. India is a very good example. We have a lot of import of crude oil, and that is one of the essential items. So when dollar gets high, we can't give up on the import of crude oil. So what happens is, what kind of goods you are importing and exporting, this theory says, that will decide what effect forex changes will have on your trade. And then lastly, we have absorption approach. Absorption approach says that forex affecting the trade is just a byproduct. Actually, the trade depends on domestic consumption and production. Any country which has more consumption than production, they will have to import the deficit. And any country that has more production than how much they consume domestically, they will export whatever extra they are producing. So this theory says trade happens because of a mismatch in domestic consumption and production. This causes trade, and forex rates simply affect the value of trade. So quantity of trade, how much you will import or export, this theory says the quantity is not dependent on forex. Only the value of that quantity, that will be affected by forex. The actual quantity that you are trading depends entirely on your domestic consumption and production. All right. So that wraps up our entire discussion of economics revision.